What if I told you there's an ETF that's almost mathematically guaranteed to lose money over time, and yet hedge funds, day traders, and panic sellers still trade it every single day? Welcome to the strange world of UVXY. UVXY is the ProShares Ultra VIX short-term futures ETF. It was launched in 2011 and is run by ProShares, one of the most well-known issuers of leveraged and inverse products. The fund is designed to deliver 1.5 times the daily performance of the S&P 500 VIX short-term futures index. In plain English, UVXY is a leveraged bet on rising market fear. When stocks crash and panic spikes, UVXY can rocket up 10, 20, even 50% in a single day. That's why it's one of the go-to tools traders reach for when the market gets scary. But here's the catch most beginners completely miss. UVXY is not actually buying the VIX itself. You cannot buy the VIX. The VIX is just a number that measures expected volatility. So instead, UVXY buys VIX futures contracts and rolls them constantly. That rolling process is where the trouble starts. Most of the time, longer-dated VIX futures cost more than shorter-dated ones. This is called contango. Every time UVXY rolls its expiring contracts into more expensive ones, it bleeds a small amount of value. Day after day, that bleed compounds. On top of that, UVXY uses 1.5 times leverage that resets every single day. Daily reset leverage works against you over long holding periods. If volatility chops sideways, you can actually lose money even when the index goes nowhere. Combine contango with daily reset, and you get one of the most consistent long-term losers in ETF history. UVXY has done multiple reverse stock splits since launch just to keep its share price out of the single digits. So how has UVXY actually performed long-term? If you had bought UVXY a decade ago and just held it, you would be down well over 99%. That is not a typo. This product is specifically engineered for short-term tactical use, not buy-and-hold investing. Now, who is UVXY actually for? It is built for sophisticated traders who want a short-term hedge against market crashes, or who are speculating on a sudden volatility spike over hours or days. Some institutions use it as portfolio insurance during nervous periods. Others trade it purely for the explosive moves during sell-offs. The honest truth is this: UVXY is one of the most misunderstood ETFs on the market. It is not broken. It is not a scam. It is doing exactly what it was designed to do, which is to track short-term VIX futures with leverage. The mistake is treating it like a long-term investment, because long-term, the math simply does not work in your favor. If you ever see UVXY skyrocketing during a market crash, remember this. By the time most retail investors buy in, the spike is usually already half over, and the contango decay starts dragging the price right back down. If this breakdown saved you from a costly mistake, smash that like button and subscribe for more clear ETF explainers, and drop a comment below. Have you ever traded UVXY or any leveraged volatility product? Was it a win, a loss, or a lesson?